participates in some of these competitions, including Safe Research Challenge, tend to show a great deal of technical abilities. So nice to meet you guys, and I will turn my video off, and then we can start. Okay.
Okay, but before we start, a few ground rules. Good morning, everybody, once again. Happy New Year to everybody. Just to reiterate, this session, please do not mute your mic unless you've been asked to. Do not unmute, rather, unless you're being asked to. If you have something to say, raise your hand, and then we'll call on you. But if you prefer to write your questions, you can use the chat box or use the question and answer session. This is just a few ground rules. Thank you. Lawal, over to you, please.
Thank you. Thank you. So let's start this way. I think, look, it's fine if, I don't know if you guys usually use the raise your hand feature, but if I ask a question, if you think you'll be very quick to answer, you can, just unmute, say something, or raise your hand, you've been called on. Just so there are no frictions. Avi, I I see your text. I think, yeah, maybe I will turn it on once in a while if I have something extremely serious to say. Okay, thank you. Thanks for the prompt. All right, so just to start, I fully appreciate that you guys you have a deadline in mind for your report, and based on that, you've probably made progress on a large part of your report, your financial analysis. Some of you maybe even valuation. I also understand that not everyone here is completely new to valuation. And well, the chat today will be a mix of, do you already know something versus, a few fundamental points in valuation. Like you, I have also pondered the question in the past, why are we even wasting time doing valuation? Will I ever value a company and the share price will hit that value that that I've come up with in my financial model? That question, sorry, I'm not sure whose mic is unmuted, but it's some background noise. Anyway, that question is, I think it's one primary thing that you need to be able to answer so that you can have some level of, one, confidence, and two, a sense of purpose when you're doing your valuation. I usually tell people that, the fundamentals or foundations of valuation, you keep it simple and you understand it when you start by understanding the concept of opportunity costs, which is essentially, what is the value of a future stream of cash flows today? That's the idea of valuation. So you think about your target company, which I think is chemical and allied products. If this company were only to operate for 1 year, and the company promises to pay you a dividend of, say, 500 naira, or let's say, to make the math easy, 1,000 naira. Or to make it even easier, the company promises to pay you a dividend of 1,200 in 2024, at the end of 2024. Value in finance is the present value of that future cash flow, at least, for the foundations, because I understand there are, several forms of valuation. And we will talk about whether those other forms of valuation are indeed valuation, and what you, as a potential research analyst, or pragmatically in this case, a research analyst, should be either valuing or doing something we call pricing. Anyway, you promised a dividend of 1,200 at the end of 2024. The value to you in finance is You think about it this way. If I had some money and I were to invest that elsewhere, which is where the concept of opportunity cost comes in, do I get the same thing? So if someone elsewhere promises you a rate of return of 20%, it means that 1,200 that you've been promised by CAP is only worth 1,000 today. Because think about it the other way, I have to invest 1,000 elsewhere to get the same 1,200 based on a 20% return on my 1,000 naira. So typically that's how we think about valuation. All right. What do I lose if I do not invest in this company? Or what do I stand to gain if I do not invest in this company? And back to economic principles, that's just the principle of opportunity cost. And it's a large part of the work you guys are going to be doing. Most of the questions you will get specifically on valuation will either be on, discount rates or some of the assumptions which are more financial modeling points than valuation points, really. But that's to set the ground rules and to understand why in the first place you're doing valuation, because you're thinking as an investor or you're thinking as a market participant who has an option, who can go elsewhere and invest their money. So if I break that down or I extend that into 1,200 at the end of 2024, let's say for the purpose of argument, another 1,200 at the end of 2025, and you keep going that way, then you assume that CAP in this case is a going concern, which means it will pay you those dividends forever. What is that? Or what are those what today? The way to do that is to think as an investor and say, if I, instead of waiting till the end of 2024 or 2025 or 2026, what if I had some cash flow, some amount I intend to invest, and I put it in, could be a treasury bill, could be a treasury bond, could be a Nigerian government bond, could be whatever, okay? What options are available to you to get the return? It is on the basis of that return that you bring those future cash flows to today to ascertain what that company is worth today. Then to the question, will my valuation ever meet the stock price? Should I feel bad if CAP trades, or if my valuation comes up with, I don't know what CAP trades at today, but let's say CAP trades at 10 naira per share today. Should I feel bad if my valuation comes to 8 naira? Should I feel bad if it's 15? Am I correct? See, one thing I have seen in the past, especially when I was a student, and I did not participate in this, but I know the general tendency for people, either today or back then, to feel like something is off if my value is significantly different from what the company trades at today. That's one. And secondly, for a company doing very well, supposedly, there is almost always a tendency for you to say, well, I need to get an upside because maybe the market isn't valuing this company enough. So the market has a price and you've come up with a value, two different things, okay, from your financial model. CAP trades at 10 naira per share today. If I get 20 naira, 100% return, does that make sense? Is that too high? Am I being too aggressive? 1 year down the line, if CAP hits my 20 naira per share, does that make me the best analyst on the streets, on Broad Street or High Street or Wall Street, wherever it is your street is? If I do not hit that, have I failed as a research analyst? The simple answer is, none of those really matter. See, intrinsic value and price are two different things. People will choose to pay what they want to pay. All right. That's essentially why there is a market. You can say it's because of market discovery or price discovery. But at the end of the day, people will have different reasons for trading a stock in a particular way. So you may not exactly get to that value. It's not supposed to be scientific. At the end of the day, it's supposed to provide guidance. You're not a prophet. You're an analyst. Okay? That's for ground rules, just to shape how you think about your valuation as a research analyst. It doesn't have to be 0.34 correct or 0.50 correct. It doesn't have to be 10 naira 50 kobo. Don't gear it towards that. Don't feel the need to adjust your work or to adjust your, whatever your assumptions are to match something you've preset in mind. You're not supposed to approach valuation as though you already had the answer. You assume there is no price because your job is to find that true value for the company. Then we can talk about valuation methodology. So I have a few slides that I will show. So I do not have specific slides for exactly everything I want to talk about, but I have a few references I will show on some slides as we discuss. On valuation methodologies, broadly, we say there are two types, and I know most of you are familiar with this. I see a few names that I think I have either interviewed or some of my colleagues have interviewed. And I know that if you guys have come this far, then something as fundamental as this would not have skipped your mind. Broadly, you have something called intrinsic or absolute valuation, and you've got relative valuation. If it's a mature company, it's not a young company. It's not, say, an EV charging company or an extremely young tech company. The primary valuation methodology you should be using, especially for a company, an industrial company such as CAP or CAP, however you choose to pronounce it, should lean more towards intrinsic than relative. And I'll explain why. But before I explain why, intrinsic valuation is supposed to be where you use something called DCF, and that's discounted cash flow. And relative valuation is where you base your valuation on a fundamental theory in finance called the law of one price, which is essentially that if two assets or two or more assets, if similar assets or similar assets generally should trade at similar multiples, which means if there is a company called Abraham PLC that earns 100 naira every year, and there is another company called Sarah PLC that earns the same 100 naira, there is no reason for Abraham to trade higher than Sarah PLC. So Abraham PLC cannot be worth 500 and Sarah PLC is worth 1,000. If that happens, there has to be a reason. But if you've compared everything, you've compared the growth, you've compared the return on capital, and the fundamentals going into both companies are growing at the same rate, they both achieve the same return on equity or return on capital for investors, then there has to be a mismatch, which is where you start to talk about whether or not a company on a relative basis is undervalued or overvalued. That's essentially the concept of relative valuation. Some people say there is also asset-based valuation, which is essentially you can look at it from an accounting perspective where you choose book value. So total assets minus total liabilities, or you choose something called a liquidation value, which is how much do I realize if I split this company into parts and sell it. That's liquidation value. You liquidate the company. You turn it from solid to liquid. All right. So you break it down and you sell the parts. And then, you have some of the parts and all these other fancy methods. But the truth is, most of those other methods, you can see there is something called LBO as well, which is a leveraged buyout. Most of those other methods are either intrinsic or relative. And for the purpose of a research analyst, it would be strange if you're considering an LBO valuation methodology. So let's just cut to the chase. You have two options. It's either you do a DCF or you do a relative valuation. A relative valuation is what you call valuation based on multiples. Those multiples may be trading multiples, which is what are other companies in the market being traded at, or precedent transactions. Again, primarily as a research analyst doing an initiation of coverage on a company, it would be strange for you to use a precedent transaction multiple. It can be good as a cross-check, but should not be your primary valuation methodology. Okay? And under intrinsic valuation, which is DCF, there are several forms of DCF, some of which I've already talked about, LBO and all that. But essentially, in the context of actual valuation, which is which cash flows do you forecast over time and discount to today? There are three primary forms. I like to think most valuation starts with DDM, which is dividend discount model, because most people think about companies and say, how much will I get as dividends from this company forever or whatever, okay, or in the next 5 years? So if I invest 100 naira in a company today, foundational principles of capital budgeting or investment appraisal requires that you calculate, is it my payback period? Is it my accounting rate of return, which is if I get dividends of 10 naira at the end of 2024 and I've invested 100, then my return is 10%, right? Then you say dividends over 5 years, dividends over 10 years, you can calculate your payback period. You can do all sorts of analysis on that. But that's on the principle of what you actually get from a company. I mean, not sure if it's very common in Nigeria these days. I mean, back when I was a research analyst in Nigeria, it wasn't very common, but so that you return money to shareholders through dividends or through buybacks. Buybacks are more common in more developed economies, but stick to dividends. That's how most people would think about valuation primarily. However, it doesn't stop there, which is why you branch out into other forms of valuation, which is, look, for your benefit, this is me as a company, as CAP speaking now. For your benefit, I may generate enough cash flows and deliver everything to you today. However, would you rather I gave you 10 naira in dividends today, or I retain some of that cash, reinvest, grow, and give you more in future? I guess the latter sounds more interesting, except if you're, a kind of investor that prefers bird in hand, which is I want my money and I want it right now. That's when you want all your returns as dividends. But what a lot of companies do is, even if they've generated enough, they don't pay everything as dividends, especially in the same year. So you may get some as dividends, but some of the cash flows may be retained. So the question then is, should I value the company based on what I get today or based on the potential to deliver returns in future? If you lean more towards the potential of the company to generate more returns in future, then you can start talking about valuing not just the dividends, but the free cash flows of that company, which is where the concept of free cash flows to equity, which is the total cash flows available, keyword is available, to shareholders, not cash flows distributed. It is distributable, but not distributed to shareholders versus free cash flows to firm, which is cash flows available to be quote unquote distributed to all investors. So debt and equity investors. So we've moved from why people think about valuation primarily as a dividend-based approach to the potential of the company, which is why you do free cash flows to equity, also called levered free cash flows, and free cash flows to firm, unlevered free cash flows. So if you do a DCF, it is usually one of these three methods, okay? Now, I do not know if there is a recommendation by, the CFA research guidelines to use one particular method of valuation. I would guess that you are allowed to think and say, what is the most appropriate method to use to value my company? Does it pay dividends a lot? Should I value it on that basis? Maybe it doesn't pay as much in dividends. It has a lot of cash flows. And I see that this company is growing. So some of those cash flows are retained in the business, even post CapEx, for future growth, to boost the free cash flows or to boost the potential returns to investors. Okay. Then maybe I want to do free cash flows. So which free cash flows do I use? Do I use free cash flows to firm or free cash flows to equity? I will stop there for a moment because I realize it may be a bit for some people to take in all at once. And if you have any question at this point, now listen, again, I understand that some of you have done some work on your report. So if you're already thinking, I have done this, how do I justify it? Or I haven't done it, what do I do? This is a chance to ask that question, that burning question. So if you have any question, I'll just pause for a minute and then I'll take it. Okay? In the meantime, I will share my screen. So this is something I used, although that was used for me, essentially, as an internship, as an intern, rather. So during my internship is what I meant. I know you guys have done, I may be wrong, but so let me know if that's right. Have done a training on financial modeling. Now, so this is not a financial modeling, session. So I will not talk about how to calculate free cash flows from revenue. I will touch on it briefly, but I won't go into the exact, mechanics of doing. I don't know if that's supposed to be within the scope, and if there's someone on the call that knows better what the scope should be, please let me know so that I do not assume wrongly. And if it is helpful to just, very quickly cover it again, I am more than happy to, to do that. For conscience sake, I will do it anyway. I think there is something in the chat box. Okay. All right, AB, I see you. So I have talked about how to think about valuation from dividends, then we came back sort of to free cash flows and divided that into free cash flows to firm and free cash flows to equity. However, when you're doing your valuation, you should start by trying to arrive at your free cash flows to firm first, which is your unlevered free cash flows, and then maybe get to dividends, whichever way it is that you like it. Usually, you move from free cash flows to firm to free cash flows to equity. Okay? It's in interviews. If I've ever interviewed any one of you, I think there's someone that I've interviewed here. I must have asked you to bridge from unlevered free cash flow, which is free cash flows to firm, to free cash flows to equity. And I guess that person did a good job. So to very quickly go through it, the most common way, now you are a research analyst, I am an investment banker. Usually, we have approaches, but there are certain things that we can agree on. One is, well, usually, again, not always, the best way to start your DCF is you've done your revenue, you've done your cost of sales, you get your gross profits, take out your OPEX, you get something called operating profit. For simplicity, I will assume that that operating profit is EBIT, which is earnings before interest and tax. Caveat, they are not always the same thing, but that's more financial modeling than valuation. All right. And the reason I said they are not the same thing is operating profit is very strictly an accounting measure of profit. Very strictly. Okay. earnings before interest and tax is not strictly an accounting measure. It's non-GAAP. And by non-GAAP, I mean non-generally accepted or generally accepted accounting principles, which it's not an IFRS measure. So there are a few things we do to it. You clean it up. You say, for example, are there restructuring charges in my operating profit? If there are they expected to persist? Will the company always spend money on restructuring charges? If the company will not always do that, you need to take it out. As the company earned, some 30 billion or 30 million naira, one-off, it will never happen again. And that is included in my operating profit. If it will not happen again, if it's non-recurring, which is the word we usually use, then you take it out. Now, once you start making some of those adjustments, for accountants would say extraordinary or exceptional items, non-recurring items, they are large, but they are infrequent, okay? Large restructuring costs, something has happened, or the company recorded a large impairment in 1 year. Could be because interest rates went so high and it affected some of their assets. They had to do some write downs, and that results in a dip in operating profit. If it will not continue, then don't drag that operating profit. Don't just say I grow my revenue by, or I grow my cost of sales, or I grow my OPEX by 5%. There is something in that 5% that will not continue. So usually you clean up your operating profit and you get to something called your EBIT. Again, your EBIT is earnings before interest and tax. Now, those adjustments are not accounting adjustments, which is why we do not say operating profit. We say earnings before interest and tax. Okay, it's just a way to differentiate between them. Anyway, you get to your earnings before interest and tax, which is where my job comes in. Then you make some adjustments. The first adjustment you make is you apply tax, your tax rates on that earnings before interest and tax. Now, before I continue, I want to ask a question, okay? And I'm going to pick someone randomly in case somebody is sleeping at 9:41 a.m. Nigerian time. Let me look at someone whose name sounds very nice. Francis Ogundoku. Are you there? I know you, by the way.
Yes, sir.
Very good. Now, I have my EBIT, my earnings before interest and tax. I am about to get something called net operating profit after tax, or as we call it, earnings before, or earnings essentially after tax, but it's an operating earnings. So let's keep it very simple. Let's call it operating profit. I'm about to get net operating profit, but after tax. Which tax do I use? Now, to set the scene, correct me if I'm wrong, Nigeria still has a 30% corporation tax rate. Is that correct?
Yes, it is.
Very good. Do I use the company's effective tax rates, or I use that 30% corporation tax rate? Francis, I am trying to get to my unlevered free cash flow, which is my free cash flows to firm. That's what I'm trying to get to. What do I use?
The company effective tax rate.
Why, Francis?
Yeah, because I think that's more specific to the company as to the general 30%, and shows the net of earnings for the company that you're trying to value at that point.
All right. I'm inclined to believe that a lot of people would agree that that's the way to do it, effective tax rate. Unfortunately, it's not. And I will tell you why. All right. Usually when you do your valuation, you start from your earnings before interest and tax, and then, I'll explain. You apply a tax rate, you get something called net operating profit after tax. Okay, follow me. And then from your net operating profit after tax, you make some adjustments, right? You add back non-cash expenses. An example is depreciation. Another example is amortization. If you have impairments, those, non-cash expenses. then you adjust for working capital. And the reason you adjust for working capital is because your working capital changes are investments. Okay, not a lot of people think about it this way, but there are two kinds of investments that you need to take out before money can be available to all investors. So remember, we're trying to get what? Unlevered free cash flows. Free cash flows available to all investors, to firm. So typically everyone says, well, I start with my net operating after tax, I take out or I add back my D&A, then I adjust for working capital. That gets me my cash flow from operations. Fine, fair enough. Then you take out capex, and then you get your free cash flows to firm. The reason you take out capex is the same reason you take out your working capital, or you adjust for working capital changes. And to keep it very simple for you guys, I like to use inventory as an example. All right, you need to invest. You're either investing in capex form or you're investing in working capital. Look, at the end of the day, it's capital expenditure and working capital. They are both capital. They need to be invested. So if my inventory was 50 million last year, 50 million naira, and this year it's going to be 80 million naira, it means my inventory is increasing. It's increasing by 30. You need inventory to run a business. So you are investing 30 million. That is when you adjust for changes in working capital. Okay? So you've taken care of that. You've taken care of capex. You get your free cash flows to firm. Remember that it is also called an unlevered free cash flow. A very quick question for anyone, maybe not Francis. When I say lever versus unlever, what do I mean? What am I talking about? Who knows what I mean? When I say leverage, generally, what am I talking about? Anybody? Generally, when I say leverage, what do I mean?
Leverage means debt.
Yeah. Leverage is, yeah. Financial leverage means debt. Leverage generally means something being fixed. So you could have operating leverage, you could have financial leverage. The reason you say leverage means debt is because the return on debt is interest, and interest is fixed. You cannot escape it. So the quality of something not varying with your operations is leverage. So it could be operating leverage, in which case you have fixed costs like rent. Whether or not your production increases or reduces, you pay the same rent. That's a fixed cost. That's operating leverage, right? Whether or not your operations, whether or not you produce or you sell 50 million units versus 100 million units, you will pay the same interest cost. So that's leverage. But that answers my question. That's financial leverage. So leverage in this context means debt. Now, gentlemen and ladies, we've said unlevered free cash flows, which is free cash flows to firm, means free cash flows available to debt holders and to shareholders, which means that free cash flow should not have anything that has to do with interest in it. It should be before interest. Now, Francis, the danger with using your effective tax rate is that, for those who do not know, effective tax rate means you've calculated your PBT. Your PBT is your profit before tax. Remember, your PBT is after deducting interest. You then apply a tax rate on that PBT. That tax rate or that tax amount you are effectively paying when divided by your PBT is your effective tax rate. What that means is, I'm not sure if you've heard this before, but interest is tax deductible, which means interest reduces the effective tax that you pay. If you apply an effective tax rate on an operating profit to get an unlevered free cash flow, you have accounted for interest in that tax rate. It should not be done. Okay? Not sure if that makes sense, if that was too much, but Francis, does that make sense?
Yes, it does.
Okay.
A lot of sense. Yeah, thank you.
All right, thank you. So marginal tax rate, gentlemen and ladies, marginal tax rate. When you're doing your DCF, you can do your three financial statements all you want. But when you're doing an unlevered free cash flow, if you're doing a free cash flow to firm valuation, it should be a marginal tax rate. Why is this important? I know some of you will get away with it when you present you just tell them tax rates. But the guy checking your research report sees it. His name is Oluwafemi Lawal, and he sees that you've used an effective tax rate. 0. Maybe not 0. I'm kidding. It's not that serious. It's not that deep. Okay? But it should not be effective tax rate if you're doing an unlevered free cash flow valuation. Anyway, you move on from there to calculate your free cash flows to equity. And to get your free cash flows to equity, what do? Remember that you've gotten your net operating profit after tax, you've adjusted for working capital, you've added back non-cash expenses. Why? Because you started from an accounting measure of profit, but now you need cash. As people say, cash is king, right? So all those non-cash expenses, you need to what? You need to add them back, right? So depreciation has been deducted, you add it back. You get your cash flow from operations when you do that. You take out CapEx, which is capital expenditure, you get your free cash flows to firm or your unlevered free cash flows. From that, to get your free cash flows to equity, you do two things. You take out interests net of tax. That's where your tax shield comes in, not at the point of your marginal tax rate. Okay, you will get your tax shield, but not for free cash flows to firm. Why? Because that benefit you get, the benefit from interest does not accrue to debt holders. The benefit accrues instead to shareholders. They are the ones who benefit from a lower tax rate. The guy who lends you money has no business with what your tax rate is. He doesn't even care. He gets his interest, and he walks away. But your shareholder, which is the final equity holder, gets significant benefits. Why? Because if you pay lower taxes, because you've paid interest, then there is enough money to distribute to your shareholders as dividends. That is the guy who gets the benefit of a tax shield. Okay? So you say interest net of tax, you take that out, and then you adjust something called net borrowings. Okay? Net borrowings. And your net borrowings or your net repayment is simply you add what you have borrowed, because that increases the cash you have. If you like, you can pay all the cash you've borrowed to shareholders as dividend. It happens, all right? It's called a dividend recap. It's not encouraged, but it happens. And then you take out how much you have to repay, because that reduces the cash available to be distributed to equity holders or to shareholders, all right? So that gets you to your free cash flows to equity. Now, if you are doing a DCF, you need one of these two things. It's either you're doing a free cash flows to firm valuation, which is an unlevered valuation, you're doing a free cash flows to equity or a levered cash flow valuation. If you were doing DDM, I mean, your dividend policy can be based on anything. It can be based on, net income. You don't need to go this far if that's what you're doing. All right. I do not encourage a DDM. I mean, most times, except if you're doing valuation for companies that don't necessarily need to invest in a lot of capex, like balance sheet driven companies, for example, banks. They are balance sheet driven. All right. They're not essentially capex driven. A bank can have especially a digital bank, can have 20 more customers without necessarily building a new office. Yeah. But to produce more, sometimes you need to, do R&D, you need to, invest in machines. If it's not growth capex, you need maintenance capex. So two different things. Okay. That's not to say you can't do a DDM. If the company has a consistent history of paying dividends and you expect them to keep paying dividends in future, blah, blah, blah. But that's essentially how you get to either your dividends, free cash flows to firm, or free cash flows to equity. These three things. That's for starters. Where does the actual valuation come in? But before I do that, let's just very quickly, I know you guys can see my screen. There is a page 156 here that talks about what you do in a DCF. So in a DCF, you forecast your free cash flows. You see, it doesn't specify whether it's free cash flows to firm or free cash flows to equity. Until steady state, you calculate your WACC, you do your terminal value, you discount the cash flows to today, and you calculate your
Hello. Hello.
Hello.
Sorry to cut you. Hey, there's a question in the chat.
There's a question in the chat.
So Gift Rabbi is saying, I have come across, yeah. So I think in reference to, she needs you to explain interest payment reduces tax.
Yeah. Okay. All right. I'll share my screen very briefly. This is going to. Can you see my Excel? I assume yes. All right. So, operating profits. Let's assume it's 200. This is a company with no debt. This is a company with debt. They both have 200 in operating profits. Okay. After operating profits, your income statement is divided into operating and financial, right? You've got interest. So interest. This company has no debt, so interest would be 0. Yeah. And then you get to something called EBT. But let's say this other company pays an interest of 10. Its EBT is 190. All right. Tax at, let's say, 30% corporate tax rate is, all right. So 30% of 200 is 60. Then you get a profits after tax of, you add these two. Yeah. So my tax is 60. But what is my tax for the company that has debts? And because it has debt, it has interest, right? Same company, same operating profits, but different tax amounts. You see that? Yeah? Hello? Can you guys hear me?
Yes, we can.
Okay. Yeah. So interest payment reduces tax. That's what it means, essentially. So think about your interest growing to 50. It keeps reducing the amount of tax that you have to pay. Okay? Reduces something called your tax burden. Okay. Yeah. She gets it. Okay. Cool. So I will stop sharing that. Okay. So guys, we've gone through cash flows, the cash flows that you need for valuation. So now we get to those, parameters you actually need for valuation. And this is where it gets, a bit more technical. These are important questions, as we like to say. There are some important concepts in valuation that you need to know. But, not to jump the gun, DCF steps. That's what I was showing on my screen the other time. So I'll just show it again. For those of you who do not know, and look, I'm sorry if it looks like I'm not covering what you guys thought I would cover. It's because this is my understanding of valuation. So my understanding is I'm not supposed to, and again, correct me if I'm wrong. I know we have just 2 hours. I'm not supposed to cover the exact intricacies of how to get free cash flows, how to do this, what to do on a model. So I'm just doing this as preliminary stuff that you guys need to understand when calculating your your numbers to get to what you actually need to value. So this is what I was talking about before. Forecast free cash flows, that's your adjusted operating profit. You take out that, you get your NOPAT. You take out tax, you get your NOPAT or your EBIT. Then you adjust for D&A and working capital. Sorry, guys, give me just 1 minute. Hello? Yeah, sorry, can you guys hear me? Hello?
Yes.
All right, cool. Yeah, so as I was saying, that's essentially, how you get to your, okay. That's essentially how you get to your, cash flows used for the valuation. Look, as I mentioned before, so this is not designed for you guys. I did not prepare this. It's just something that I have, that has been used for me as a training, in the past by an organization called Financial Edge. Did a training for us during my internship. Very useful material. So again, some of the most important concepts I'll be talking about are from a separate material, cost of equity and all that stuff I'll be talking about. But this is just to show you guys what a typical process looks like for calculating your free cash flows, and not what the session indeed is about, because that's more financial modeling than valuation in itself. But that's how you get to your free cash flows. So I'll take a very short, I'll stop very briefly and ask the question. So if you're doing a free cash flows to firm valuation and you've come to the point where you need to discount your free cash flows, what discount rates do you use? And what discount rate do you use when you're doing a free cash flows to equity valuation? And in a free cash flows to equity valuation, or let's say in a dividend discount model, what discount rates do you use? I need someone to answer that. And that someone should be Mubarak.
Okay.
Mubarak.
Hi.
Yeah.
Yeah. Thank you. So, if you're making use of free cash flow to the firm, so I think we're making use of the WACC to discount it.
Okay.
And we're making use of free cash flow to the. Sir?
No, go on.
So, and we're making use of free cash flow to the equity. Then we're making use of our cost of equity to discount it.
Okay. And what if you're doing a dividend discount model, dividend discount methodology?
So, if you're actually using a DDM primarily, I believe we are most likely supposed to be using a cost of equity, but mostly I've seen people making use of the WACC instead.
Well, it's cost of equity. So yeah, that's fine. So cost of equity for your free cash flows to equity, anything that goes directly to your shareholders, you use the cost of equity. There cannot be a mismatch between the cash flows being used and your discount rate. Okay. So the next set of questions, which are the most important questions, should go through in the next 15 minutes. These concepts of WACC and cost of equity. Now, a lot of you know how to calculate cost of equity from a theoretical perspective. From a practical perspective, how do you calculate that cost of equity? Usually, you use CAPM, and CAPM is capital asset pricing model for your cost of equity. And how do you calculate that? Now, it depends on your cash flow. So if you're valuing a US dollar company, US dollar cash flow company, you use, or you think in light of the USD for your cost of equity. But TAP is a company that earns Naira, okay? And so your cost of equity has to be denominated in that same currency, in Naira. So if I were doing a valuation in the US, what I would do is I would go, my cost of equity is my risk-free rates, starting from my risk-free rates, okay? Always starting from my risk-free rates, which would usually be a government bond yield. Could be a 10-year, could be 5-year, could be 20-year. There are usually debates about, oh, should I use 5 years? Should I use 10 years? Should I use 20 years? Some say use 5 years because you are projecting your explicit free cash flows for 5 years. Sounds like a reasonable argument, but not totally correct. Okay, that's not to say you can't use 5 years. Remember that your valuation is split in two. You have your explicit period cash flows, and then you have your terminal value, which looks at the value of the company forever. Forever has no limits, right? So is it essentially correct to say my risk-free rate should be 5 years because I'm projecting for 5 years? No, you are not projecting for 5 years. You're projecting for more than 5 years. Can I use 10 years? Yes, that's fine, because that covers the first 5 years and maybe covers a part of your terminal value. Can I use 20 years? Yes, that's fine as well. Can I use 30 years? It gets a bit more tricky, or it gets trickier, because you can say, I think 30 years covers a very large part of my terminal value beyond the first 5 years I have projected, because terminal value is forever. So maybe I should use 30 years because that's kind of forever. At least it's the most forever among all the tenors from 5 to 30. You have to be careful because whatever you're using has to be something that has liquidity. It has to be something that trades, something people believe in. If people don't buy 30-year bonds in your country, like Nigeria, which I think, I mean, there probably is. I'm just not sure how liquid. And by liquid, I mean, do people trade it? Is the yield reflective of the actual value that investors believe in? Or it's just there and it's just one person buying it? If one out of 180 million people are trading 30-year bond yields, then that is not the right, risk-free rate. Here in Nigeria, and 20 years doesn't seem liquid enough. Just stick to your 10 years because that's what reflects what people actually think. Okay? So there are different arguments. Just make sure that whatever you're choosing matches your specific situation. You could be projecting for 5 years, projecting for 10 years. That's your explicit cash flows before you do your terminal value. All right? Then your CAPM being risk-free rate plus beta multiplied by your equity risk premium. And then in some cases, you have something called country risk premium. I do not think for you guys, depending on how you approach it, it will be relevant, but I'll talk about it as well. The question then is, how do you get your beta? Now, CAPM is easy. Everybody knows CAPM, right? Risk-free rate plus beta multiplied by your equity risk premium. What is beta? What does it measure? People say it measures the volatility, it measures systematic risk, it measures, several things. That's fine, theoretically, but how do you actually calculate beta? Maybe I ask someone else what their approach is to calculating their beta, so we know if we're doing the right thing or the wrong thing. Let me call on Peace Nachi. I hope I did not murder your name. Hi, Peace. No, not Peace.
Good morning. Sorry, I didn't get your question correctly.
My question is, how are you calculating your beta for your research report? What approach have you used to get your beta? Beta. No, you're not there yet, because valuation is at the end. Fine. Anyone?
Yes,
Good morning,
I'm
sir.
not there.
Akinkumi. Yeah, go on.
Thank you. So, I think we get daily returns for uh, the index. So okay, I think the trading platform, it could be the NGX, could be the S&P 500. So the company is trading on S&P 500. So we can download the daily returns for that, and also the daily returns for the stock itself for the company. Then we calculate the daily returns for the for the index, and also the daily return for the stock. Then on the Excel sheet that we can use the covariance method, we get the covariance of the index and also the covariance of the stock, then divided by the covariance of the market for the index. Then we can do that, or we can use the slope method to calculate it.
Okay. Now, when you get that, stay on the line, stay on the line. When you get that, what kind of data do you get? Do you get an unadjusted data? Do you get an adjusted data? And do you get a levered beta or an unlevered beta?
Okay, I think we get unadjusted beta, and I think we get levered beta. Then we unlevered it. I mean, if we are using unlevered free cash flow, we unlevered it to, adjusted to use it in our unlevered value.
Okay, so good, thank you. Beta can sometimes be calculated using regression. By regression, it's essentially what he has said. You look at because beta, as you would say, measures systematic risk. And so it measures the risk affected that affects a company, a risk you cannot diversify, essentially. It's endemic to the system. It's a systematic risk. And that would usually be reflected in how you trade versus the market. So if the market is very volatile, if the returns change, by quite a lot, versus how you change as a stock. Sometimes we just use it as an approximate way of measuring how a company would perform relative to how the market would perform. Yeah. So you calculate, as I said, the daily returns on the stock on the exchange on which that stock is listed. There are arguments for and against that, but for the purpose of this, for this session, we can keep it to the NSE/ASI, for example, the NGX. I don't know what it's called these days. And then you calculate the returns, the daily returns, could be monthly as well, could be the weekly returns, but keep it daily so that you can sleep well at night. You calculate that, you go back. Some do, you do 2 year for the last 2 years on a weekly basis. Some say, let's do for the last 5 years on a monthly basis. You can use either, but both, or in some cases, you do 5-year weekly as well. Now, why do people not use daily? Because they think there are lots of changes that happen on a daily basis, right? So it can increase volatility unnecessarily. So you probably don't want that. So weekly, because it's relatively more normalized. And how far back do you want to go? Not 1 year, because if you take 1 year as an example, you take what has happened last year, that's going to distort your value. Last year is not a typical year in a market environment, right? 2 years, in fact, if I look at the last 2 years, I would probably say maybe not, because the last 2 years have been characterized not by, especially in the developed market, right? Maybe not in Nigeria, I'm not sure. But you probably want something that makes someone look at it and says, okay, this takes care of both the good times and the bad times. Now, the idea is not for you to avoid the bad times, all right? The idea is not for you to skip COVID. That's not the idea. Don't say, I'm stripping out COVID. A lot of people do that when they do analysis, especially analysis like volatility. You are supposed to include that because that's what your data is supposed to measure, right? You say, oh, I have not included this because, you know, it's a COVID year or something happened or interest rate, something, but you're measuring beta, you're measuring risk. Beta is a measure of risk. That is beta's job, to look at when bad things happen and maybe when good things happen. So don't just stick to the bad years, but don't also, you know, just close your eyes and say, yo, I will not use the bad years. I have done my beta. I have removed 2020 because COVID happened in 2020 and it's not representative of what market should be. Or last year or 2 years ago, there was Russian-Ukraine crisis. Or last year, interest rates were artificially high. Inflation was high, so I did not use it. No, that's not correct, okay? So use a 5-year period, something that accommodates maybe both the good times and the bad times. You calculate your covariance to get what your result is. Do that on the market, do that on the stock, calculate what's the slope or what's the, you know, depending on however it is you want to calculate your slope. You get your beta. Good answer from Akinkunmi. That data you get is unadjusted because you've used, you know, could be a 2-year, could be a 5-year, but people believe there is it's a theory by someone called Bloom, B-L-U-M-E, that says over a period of something years, data tends to adjust itself to 1. And so that beta you've calculated using regression, which is unadjusted, you have to adjust it. And how do you adjust that? You do something called an adjusted beta. And that's essentially there is a very simple formula to calculate it, which is, I think, 2/3 multiplied by the unadjusted beta plus 1/3 multiplied by 1, which is irrelevant in any case. Essentially, what happens when you do that is if your beta was higher than 1, it moves down towards 1. And if it was lower than 1, it moves up towards 1. All right? But it generally pulls the beta in one direction or the other, depending on where your beta is coming from. That's the idea of adjusted beta. Just make sure, all right, you may not get the exact equation now, but make sure that if you're doing that, you adjust your beta, all right, by using that Bloom method. Bloom is spelled B-L-U-M-E, okay? And that beta is also levered, all right, because if the company has leverage, then, you know, in how the company trades, the leverage would be implicit in that. Why is this important to know if your beta is levered or unlevered? If you're doing a single point estimate, you see, a lot of times the idea doing the valuation is to get, especially when you're calculating your discount rate, parameters like that, you want something representative of the long term. So I don't want to base my beta on the current capital structure of the company because maybe that is not the optimal and that's the target capital structure. So what people tend to do is make some adjustments to that beta. Now, if you're doing your regression beta, you may not necessarily need to do that because you've gotten 11 beta already. You can as well move on with that. But there's another approach which some of you are probably doing. For those of you that have access to Bloomberg or to Refinitiv or to FactSet or whatever it is you're using, another approach people use is they come up with peers, the peers of a company, all right? And by peers, you know how to select your peers by now if you've done your industry analysis. So which companies, you know, are they in the same industry or similar industry? Now, not same, but similar. All right, you need to think like an investor. It may not be an AI company, but will I buy that AI company or will I buy another tech company in place of that AI company? Well, if I can replace one for the other in terms of my exposure, then maybe similar industry, not exactly the same industry. Again, what I mean is if a company is producing palm oil and another company is producing groundnut oil, and I want to get exposure as an investor, but I just want to get exposure to oil. Oil is oil. If it is palm oil or to, you know, groundnut oil, what I want exposure to is agricultural companies. So it may look like Okomo is the only peer of Presco, but that's not always true because an investor may not necessarily care about whether or not it is palm oil. All they want exposure to is agricultural products. So my peers would not only be, for example, for Okomo, would not only be for Presco, to also be, you know, other agricultural companies. If that is the way investors think about it. If investors think they are substitutable in terms of what they hold as a portfolio. I know, Mubarak. You need to do the Bloom adjustment. No, you need to do it. Okay. Now, what I was talking about is slightly different, and I'll get there. Anyway, pick your peers. For CAP, I don't know, you guys probably know better. There is Burger Paints, there is something, there is another one. You put all those peers together. If you think that the peers of CAP are not only paint producing companies, there are also other companies that produce chemical products, because an investor would not say, I only want exposure to paint, and so I will treat them the same way. I will value them the same. If the fundamentals are the same thing, if paint uses a raw material that is the same thing as what another chemical uses, they are exposed to the same dynamics, the same economics, right? They are both exposed to the Nigerian market. So they should ideally trade the same way. They are similar. They are not the same, but they are similar. Okay. So similar industry, similar geographic exposure. By geographic exposure, I mean, look, it doesn't have to be just Nigerian companies, right? If a foreign investor, as an example, now it may be slightly different in Nigerian context, but here, what we do is, if I'm in the UK and I'm valuing a UK company, it doesn't mean I only use UK companies in my set. I can use a German company, because most times when investors think about companies to invest in, they think about Europe. So that's the geographical exposure. All right. So, and by geographical exposure, it doesn't mean where you are as a company. It means where you are exposed to. All right. If you are in Nigeria, but you are selling only to the US, well, if that happens, good for you. You are based in Nigeria, but you are selling only to the US. You are exposed to two countries. You are exposed to Nigeria in terms of whatever happens politically, whatever can happen to your taxes, or to, there is a coup d'etat, there is something, you are also exposed to the guys you actually sell to, where your demand comes from. Okay. So exposure is what matters, not domicile. Well, I'm based in Nigeria, that's all. Well, if CAP sells to South Africa, they're slightly exposed to whatever happens in South Africa. All right, and then you look at maybe leverage as well. Do they have similar leverage? Yeah, these are the things that you need to look at when you pick your peers. So the reason I'm explaining this is both for your relative valuation and for those of you who, pick your beta from Bloomberg. So typically, if you're picking your beta from Bloomberg, what you do is you go to the Bloomberg terminal, you say, oh, Bloomberg, I want a regression of CAP against NSE/ASI for the last 5 years on a weekly basis, and I want an adjusted beta. Now, you will not just pick that beta. What people do is assume that the market is inefficient. And so what they do is by using peers, the peers of CAP. So they pick, well, companies A, B, C, D, E, and F. They arrange the betas, all right? They get that beta that you get, similar to the regression you've done. You get a levered beta, and it's already adjusted. You don't need to adjust that one when you're picking it from Bloomberg. Okay? Then you do something called unlevering the beta. And the reason you do that is you want to strip out the capital structure of each one of those companies from the beta. When you do that, you get an unlevered beta. You do the average of that unlevered beta for each one of the companies. There's a formula to do that. Unfortunately, I do not have it on screen. Sorry. But, just general principles. You unlever the beta, gets the median or average of the beta, depending on which statistic you feel more comfortable with. I generally tend towards medians because they strip out the extreme values. But median can also be reliant on just one company. The company that is in the middle may just be some random company that has nothing to do with your so anyway, you get that average or you get the median, then you relever, which means you now say, look, I have stripped out the levered betas. I have stripped out the capital structure of these companies from their levered betas to get their unlevered beta. Why am I doing that in the first place? I want to get a beta representative of that sector, of that industry. I want nothing to do with their capital structure because this company has its own capital structure or has a target capital structure. That target capital structure could be based on the average of the capital structure of the peers as well. It could be based on what the company has communicated in the past. Oh, we are going to do a debt to capital ratio of 50%. Or our net debt to EBITDA is going to be something times or something like that. Okay. Now, when you do that, you get the unlevered beta stripped out of capital structure That represents the industry in itself. You do the average of that, you get the median beta, and then you relever that using this company's capital structure, either current capital structure or target capital structure, whichever one you think is representative of the long-term capital structure of that company. And that's how you get your data, all right? That's an alternative way to get it besides using regression. And then you multiply that by your equity risk premium. Now, in my experience, for equity risk premium, what people would do is they go to a website called, or to some guy who I really respect. His name is Aswat Damodaran. All right. Now you can do that. You can pick the equity risk premium for Nigeria. So for you guys, for example, you can say, oh, 20-year government bond yield, Nigerian government bond yield. That's your risk-free rate. You've calculated your beta. How do you get your equity risk premium? You say, well, I want to use Aswat Damodaran's estimate for equity risk premium. Now, you can use it, but know how to calculate it. Now, typically, if you were in the simplest way to explain the equity risk premium is the premium of equities over bonds. That's it. Why? Because you're starting with a risk-free rate, right? The point in your CAPM is to get a return, a typical return that an investor would want on equities. You start with a risk-free rate because, well, everyone gets a risk-free rate. If they don't want to invest in your company, they can decide to invest in some government bond that is risk-free. Well, that's risk-free. That's another debate, but it's risk-free. But because they're investing in not a government bond, but your company, then they need a premium. And that premium is the equity risk premium. Now, the equity risk premium would usually be representative of, usually the country at large, or that market itself. So what people would do, the ideal way to do it, or the most fundamental way to do it, is you say, in the last, if you want to use a backward-looking estimate as an example, you say in the last 5 years, or in the last 10 years, in the last 20 years, what's the average, could be arithmetic, could be geometric returns, just because it's returns and it's based on a few years back. So what's the average returns over the last 20 years? Let's say that gives you 5% for Nigeria, all right, on a typical government bond. What's the average return? And then you say, what about the NSE ASI? In the last 20 years, what's the average return been? It's 20%. So 20% is the market return if you invested in this, in the stock market index. But in the last 20 years, government returns have been 5%. So what's the delta? What's the difference? That's 20% minus 5%. You get 15%. That's the premium you get on equities over bonds. That's why it's called a premium, equity risk premium. The premium you pay for taking risk in an equity market. So that's it. That's your 15%. So if you want to calculate it yourself, that's a very simple way to do it. The challenge is not a lot of companies or not a lot of countries have indexes that go that far back. Like they don't have something you can say is representative of what the future will be. For example, for the US, you have something that goes back as far as maybe you want it. Could be 1990, could be 1900, I don't know, whatever. But it goes far back, so it's reliable, right? It's been tested and tried over a number of years. So what Aswat does is to base its equity risk premium on the US market because it's a mature market now. It does the average of that historically, and then to get your country. So if you go there, if you go to his website, you see. So I'll just share my screen very briefly. Okay, let me see if I have it open. Yeah, I think I do. But the one I have is from July. I know he has started releasing data for 2024, but I don't think this is out yet. So again, says just for illustration, not mine. Not mine. I did not come up with this. So if you go to his website, you will find this Excel sheet. Just Google and the modern equity risk premium. Yeah. So this line for Nigeria is what you need. And this total equity risk premium is what you need, 16.38%. This is what is estimated for the equity risk premium for Nigeria was in July 2023. He's going to release something for January very soon, so you can use that as well. But just to let you know how it does it generally, it starts from a developed market, which is often the US. It calculates what I've just told you, the delta between the equity returns on the, for example, S&P 500 versus the treasury bond. Let's say a 10-year treasury bond, for example. he gets an equity risk premium for the US, and then he applies a country default spread. All right. Now, the exact mechanics of how this is done, I think you can check it on his website. But point is, you can use as for Damodarans, but know how to calculate it. Know that it makes sense to you as well. Okay, that's important. Now, when you mash up those three things, you've gotten your risk rate, you've gotten your cost of equity, your equity risk premium, and your beta, you get your cost of equity based on CAPM. There is a question in chat box. For the equity risk premium, if you're considering a 20-year market return average, do we have to deduct the 20-year risk-free rate? Exactly, you have to, all right? Because you've done the market return, what you're trying to get is the premium, right? You want to get the premium multiplied by the beta. So you want to get a risk-adjusted equity risk premium, if I can call it that. So 20-year market return, 20-year on, say, the NSE ASI. Now, the problem is you may find that the NSE ASI does not have a higher return historically than Nigerian bond returns for whatever reason, which is why ASFA tends to use a developed market because things tend to work in the way they should in those markets, for example, in the US. And then when it gets that, he applies a spread to it. The spread would usually represent the difference in risk between the US and Nigeria. An example of how you get that is you pick a Euro bond in Nigeria. It's called Eurobond, but it's not denominated in euros. It's denominated in USD. So a bond that was issued by Nigeria in, say, the US, in a foreign market, and that bond earns you 20%, or let's say 15%. But a treasury bond earns you, let's say, for the sake of argument, let's say it earns you 5%. The delta between a US denominated bond issued by Nigeria versus a US denominated bond issued by the US, that's different. 15 minus 5 gives you 10%. That 10% is the premium of Nigeria over the US, because to invest in Nigeria, you need an additional return to compensate for the risk. So one way to do that is you can start, and this is something you can do by yourself, all right? You say, yo, I pick historical market returns in the US, historical bond returns in the US. You get the delta. That's the US equity risk premium, but you're calculating an equity risk premium for a company in Nigeria. So what you then need to do is add a premium that reflects the risk that Nigeria has over the US. So that additional 10%, you can add it to it. There are several ways people come up with it. And Aswat himself has several ways of coming up with, or different ways of coming up with, different ways of thinking about it. There are some adjustments that he makes in certain cases. I've used a bond risk premium in this case. Sometimes people use something called CDS, but you don't need to worry about that. Okay, but if you want to, experiment using the NSE ASI, just stick to NSE ASI returns for the last God knows how many years, right? What's the average return, or what's the geometric average return? And then you calculate geometric returns as well on bonds. Okay, and that's how you get your equity risk premium. Just make sure that whatever method you use, it makes sense and you can explain it. Now, that's usually the hardest part, coming up with your cost of equity, because the cost of debt is very simple. All you need to do is, for CAP, for example, do they have listed bonds? Does anybody know? Well, if they don't, you're in luck. You're not in luck. If they do, very good. All you need to do is you can go to their, reports. You can go to, is it FMDQ, whatever it is that they have those bonds listed. If it's a corporate bond, you say 5-year bond, 10-year bond, 15-year bond, whatever long tenor bond that they have that has, well, preferably been recently issued. All right. And you pick the yield to maturity, not the coupon. Don't pick the coupon. It's a punishable offense. Don't do that. You pick the yield to maturity. That's what the current yield in the market is. That's what people think of the yield of the bond. So if the company were to issue the same bond today, that's the rate it would issue it. That's what you need, because your valuation is done today. And you need something for investors. The same thing goes with your risk-free rate. Try use the spot rate, except if you think, yo, inflation has been so high recently, we don't think inflation is going to be persistent or persistently high. Okay, let's use historical average. However, in a normal year, stick to your spot rate. All right. But for a bond yield, you can use what's been traded today, all right? You can use average as well, whatever it is that is available to you. In a normal year, again, you use the spot rate. So 5-year, 10-year, 20-year bond that's been issued by that company, you pick that rate. Now, unfortunately, we do not have in Nigeria a market as developed as, say, in the US or in Europe, where companies issue bonds all the time. So what do? If that company does not have a listed bond, let's say it's mostly financed by bank loans. Well, one quick way you can do it if you're an accountant is to go into the company's financial report and say, what's the interest expense for this company in 2023, 2022, 2020, whatever, pick the historical average, whatever it is you feel very comfortable with, or whatever is defendable, actually, not what you're comfortable with. Some of you can be very, clever because you're trying to get to valuation. You choose what's, gears your valuation towards that. Pick something recent. Calculate the interest expense divided by the debt. You get an effective interest cost or effective cost of debt. You can then apply the tax on that. So you do, because cost of debt, interest is tax deductible. Cost of debt, pre-tax, you multiply that by 1 minus T, tax rate. The tax rate is always marginal tax rate, 30%, except there is another, I know, back then we used to do 32% because of the education tax, right? I'm not sure if that concept still applies because I know a lot of things have changed. Maybe not a lot of things, maybe not that much. But if that concept still applies, if all companies pay 30%, they always pay 30% marginally. On every profit you make, you pay that 2%. So your marginal tax rate is not 30%, but 32%. Okay? So that gets you your cost of debt. So 2 ways of doing it. If the company has a listed bond, you can do that. If it doesn't, you can pick the average historical interest rate. In fact, another way to do it is to say, well, this is a corporate bond, right? CAP, what's your credit rating? If CAP is, rated AAA, as an example, so it's AAA, and Nigeria is rated BBB, then there is a delta. It means that, CAP has a higher credit rating than Nigeria, and so you should borrow at a lower rate than Nigeria. That will probably not happen in many economies. It's very rare for you to find companies that have ratings higher than the sovereign. It happens, but it's not very common. It happens only to very few companies, okay? Because usually when rating agencies do that, when they do their rating analysis, they cap you at your sovereign rating. Your original rating may be different from the actual rating, that comes up after the ratings analysis. So they check your numbers, your financials look excellent. But then, if something happens in Nigeria today, you are going down as well. So they cap your rating. So more often than not, you find companies at maybe lower credit ratings or maybe the same credit rating as the sovereign, as the country in which they are domiciled or company. So let's say Nigeria is rated AAA and you're rated, again as an example, and you're rated AA. If Nigeria's, if the risk-free rate in Nigeria is 20% based on your estimates, then you need to apply a spread, a credit default spread, and assuming, okay, look, it can be, sometimes people use judgments, all right? And sometimes it can be scientific as well, but not to spend too much time on it. The general approach would be you start from Nigeria's credit rate and you say, oh, this is 15%, Nigeria borrows 15% on its 10-year bond. Because this company has a lower credit rating, and it's just one notch below, maybe AA versus A, then I'll just do, 2% extra, 5% extra, 3% extra on it. So that if the cost of debt of Nigeria is 10% or 15%, then your cost of debt, right, put 3% or 15% is 18%. Another way to do it is, if CAP doesn't have a listed bond, does it have a peer in the industry? Remember, not same, doesn't have to be same, could be similar, could be a similar sized company, all right? Similar dynamics that has a listed bond. If they do, then you can use the yield on that company's bond as a proxy for CAP's cost of debt. So there are different ways. One, if it's listed, just pick the yield to maturity on its listed bond. Or you can go to the financial statements, do the interest divided by debt to get the average cost of debt. Or you can do the country approach I mentioned, or you can use the peers. all right? So once you do that, you're able to get your WACC by doing the WACC formula. So proportion of equity divided by debt multiplied by, divided by total capital. That's your equity plus net debt multiplied by your cost of equity plus debt divided by total capital multiplied by, everyone knows the WACC formula. That's how you get your WACC. Any questions? All right? Okay, so there is another, for your DCF, there is another, what's it called? There is another elephant in the room. One thing which usually, a lot of people, get wrong, get right, depends. That's your terminal value. Remember we said that you project your free cash flows for what? A number of years. So just to very quickly touch on this, if you're doing your free cash flows to firm and you've done your valuation, what you typically get is an enterprise value. So you get an enterprise value. And from your enterprise value, you guys know how to do it. You bridge to your equity value. How do you bridge? Your enterprise value is the value of the operating assets of a company. So which means if you have to bridge from enterprise value to equity value, what you then do is you deduct debt, because enterprise value is available to all investors, but equity value is only supposed to be for shareholders. So you take out debt, you add cash. Why do you add cash? Because EV is value of operating assets. Cash is not operating, it's idle, all right? It doesn't operate, it's not working capital. That's why it's not included in working capital calculation. So you get your EV when you use your free cash flows to firm or your levered valuation. And to get your equity value, what you then do is you deduct debt, I guess you're closer to the value to equity holders. And then you add cash, because cash is not operating. It is not included in your EV, but it belongs to shareholders. So you add cash. So effectively, you say you add net debt or you deduct net debt and you get your equity value. And for you guys, because you're research analysts, you're more concerned about the target share price. So what you do is you then divide that by the number of shares. Now, should I use basic number of shares? Should I use fully diluted number of shares? Well, that's a story for another day. But I think, I may be wrong, it's not very common that you have Nigerian companies with lots of options and convertible bonds. Where is the market for convertible bonds? I'm not sure if I should be saying this, but I'm not sure it's very common in Nigeria. So it's, you can check it. I think from my initial check on CAP, they don't have any dilutive shares. Like, they don't have options. I know there are now options and a few things in the market, but maybe not by corporates. Maybe large corporates, if any corporate at all. So you probably don't need to bother about that, but check it. It's your job as a research analyst. And then you get your share price once you divide the equity value by the fully diluted number of shares. Anyway, back to terminal value. Before you get this in the first place, well, that's to mention, if you're doing your free cash flow equity valuation, you get directly, if you're doing your DDM, you get directly an equity value. So you don't need to adjust anything. You just need to divide that by the number of shares. Okay. Okay. Terminal value. So, different ways of calculating this as well. And this will take me very briefly to relative valuation, because there's something I need to talk about here in terminal value. There are broadly two ways of calculating your terminal value. You can use something called the Gordon's growth method, right? Or you can use something called the exit multiple method. By Gordon's growth method, I mean your perpetuity growth method. And what do you do? Typically, you project 5, to 10 years, and then you say, I want to calculate my terminal value. And how do you calculate your terminal value? You say, what's my free cash flow next year, multiplied by 1 plus G, and you divide that by WACC. If you're doing free cash flows to firm minus G. If you're doing free cash flows to equity, it's because of equity minus G. That G is usually a problem. It's like, how do I determine my G? That G is a perpetual growth rate. So I will quickly ask somebody, favor, I don't want to pronounce your surname at the risk of, not pronouncing it correctly. Favor, how do I determine my G, my perpetual growth rate? No, okay, no. Okay. Anyone? John Olorunfemi. I'm calculating my terminal value. I've gotten to that point where I say free cash flows multiplied by 1 minus G. How do I determine that G? Perpetuity growth rate. I think I'm alone. Are you guys still following? Am I too fast? Can you hear me? Ooh. Okay, no worries. I'll just do it myself. So people say there are several ways to calculate your G. That's your, growth rate. Academics, so people who know, their finance and went to class and did M&M 1957 and 1963 or whatever, will tell you, oh, there is something called Gordon's formula, which tells you that your growth, your perpetual growth rate, is the product. So you multiply B and R, right? Where your B is your reinvestment rate, and your R is your return on capital, so that the rate at which my free cash flows grow forever depends on two things. One is how much I reinvest, and secondly, how or what my return on capital is. So for my free cash flows to grow, first, I need to reinvest, and two, I need to return capital. I need to get returns on my capital. If your returns on capital is zero, your free cash flow is going nowhere, even though you reinvest. And you can't really get, sufficient returns on capital if you do not reinvest. So if you don't reinvest, it is still zero at the end of the day. So your growth is a measure of, or it's a combination of these two things. So B and R, where B is your investment rate multiplied by your return on capital. That's one way to think about it. A more, I would say, practical or pragmatic way to think about it, which is what a lot of people do, is they say, what's the GDP growth rate in the economy going forward? And then, well, I don't know what it is in Nigeria, unfortunately. I don't know how the economy has been growing recently. But maybe let's take an example, 2%, 3%, 4%, 5%, could be anything. So you say, I think, could be based on an estimate from IMF, World Bank, or some reputable economic institution in Nigeria, or some research analyst said something and you believe the research analyst and you agree with them because it just makes sense. Let's say it's 5%. So one way to think about it is, what's the long-term GDP growth rate in Nigeria? I can use that as, an estimate of what my growth is going to be. Why? Because that growth is steady state growth. It's supposed to be the growth when other things have been equal, your WACC approaches your return on capital, your, company has, gotten to a stage where it only needs to invest maybe maintenance capex. It doesn't need to grow that much anymore, because that's the assumption you're making when you get to your terminal value. If you think CAP is still young, maybe you want to project 10 years before doing, but CAP has been around since when? Since 1957. So maybe it's mature, maybe it's not. That's up to you. But you can use your long-term GDP growth rate. Now, some people say, well, my company is still young. I want to improve my valuation. Can I use 6%, even though the long-term GDP growth rate for the economy is 5%? Well, two things. One is, by doing that, implicitly you are saying that there is a tendency that at some point, to infinity, because that's what terminal value is. At some point, this company is going to be larger than the economy. No, you're saying bullshit. Because, well, the company has revenues of 20 billion naira today. Nigerian economy is what? It's so large, is like, CAP would be lost in there. But mathematically, if you keep growing that amount by, a higher growth rate than the Nigerian economy, at some point in the future, you will grow larger, or you will become larger than the economy, because it's infinity, right? So it can't even be 4.1%. All right, it can be, if Nigeria is growing 5%, it can be 5.01%. It's like saying, oh, someone is pregnant and she says, no, I'm just a little pregnant. Yo, it's one or the other. It's binary. You're either pregnant or you're not pregnant. So you're either growing larger than the economy or you're not. So it should be something lower or equal to the long-term, growth rate of the economy. Some people use inflation. I have views against that, but if it makes you feel like, well, if this company doesn't spend capex anymore, at least, its free cash flows will grow at inflation. If that inflation number is not too high, if it's not crazy, because I know Nigerian inflation right now is is on the high side, you may use that, or maybe you don't want to. All right, but inflation is generally not the way to think about it. And there are several reasons for that. But that's one practical way of thinking about is thinking about the growth rate. And that's something you should not waste a lot of time thinking about. And don't try to gear it, or don't try to arrive at something that looks off. Okay? So generally, that's how you think about your terminal growth rate. Now, that's one way. The other way is to use something called an exit multiple. Before I explain exit multiple, I need to very quickly touch on relative valuation. Now, it's not as elaborate as this here, which is why I'm saving it for last. So what's relative valuation? You say you use trading comps. Remember what I said. You probably don't want to use percent transactions. You don't use transaction multiples here. And there are several trading, multiples that you can decide to use. First, we've talked about how to choose your peers, right? Similar industry, not same industry. Similar geographical exposure, not same geographical exposure. Similar leverage, especially if you want to use a price to earnings multiple. That's very important. And I'm sure that, well, I'll get there very, very briefly. And maybe similar life cycle as well, okay? NVIDIA, I guess, is trading what, 35 times today? Maybe Apple is trading 22 times. It's not because NVIDIA is a better company, well, necessarily, than Apple. It's just because they're in different stages. There's still a lot of growth for NVIDIA versus Apple. Apple has been around for long. NVIDIA has maybe a longer way to go. So different stages of the life cycle can mean that you use different multiples, or you arrive at different multiples. So you need to be sure that they're exactly comparable. So CAP may not be the same thing as a Dangote, just in terms of life cycle, or an oil company. Different stages of life cycle. So that's also important. Young companies versus mature companies, you need to be sure that you're comparing the right things. So what multiples can you use? Typically, you use something called enterprise value multiples, which is either EV to EBIT, that's your EV to, or EV to EBITDA, versus price multiples. And the reason we, well, more often than not, favor enterprise value multiples over price multiples, so price to earnings, for example, versus EV to EBITDA, is because one is immune to leverage, right? A company has an operating profit of 100 and an EV of 1,000. Its price to earnings multiple is 10 times. If you have another company with similar operating profits, remember, they're in the same operating environment. So we are assuming law of one price, similar operating profits. But if their financial leverage or leverages are different, then you will have different price to earnings multiples. So your price to earnings multiple will usually be affected by leverage. So if you want a fair comparison, if you think, I'm looking at the closest peer, closest to CAP. CAP doesn't have debt, but this company has debt. You probably want to think twice before using that price to earnings multiple. Don't just slam it and say forward price to earnings multiple. And one thing I think I've seen some research analysts do, please do not do it. So well, if you do it, make sure you have a very good reason of doing it. Make sure that if you're using a price to earnings multiple, it's a forward multiple. By forward multiple, I mean today's price divided by future earnings. So 2024 EPS, not 2023 EPS, not 2022 EPS. All right. Valuation is usually, not always, it's usually a forward-looking exercise. And I said not always because when we use present transactions, we use LTM multiples, so historical multiples. But when you're using trading multiples, and that's for a good reason, present transaction, the transaction has happened. Trading multiples, the company is trading, it's still being valued by the market on base of future fundamentals. So use forward multiples. Price divided by 2023, 2024, 2025, 2026 earnings. All right, to get the average of that, to multiply by your target company's EPS. But to use that, you need to make sure that the leverage is similar if you're using a price to earnings multiple. If you're using an EV to EBITDA multiple, you say EV to EBITDA of peers, right? You get your EV from the market. You can, I think that's, I'm not sure how easy it is to get for you guys, but you can, it's something you can compute by yourself, right? To get the market value of that company, you add net debt, you do the other EV to EBITDA, or sorry, EV to equity value adjustments from your EV to equity value bridge. You get the EV and you divide that by the EBITDA. All right. And I've explained the reason we do this law of one price. If the companies are similar by the law of one price, they should trade at similar multiples. So you average that and say, oh, the market could be wrong about this company, but on average, the market should be right. So by average of peers, let's say you get 5 times. You multiply the 5 times and you get the average EBIT to EBITDA by the EBITDA, forward EBITDA of CAP as an example. And then you get what the EV of the company is. You're a research analyst. You have less business with EV. More often than not, what you want to get is a target share price, right? So you say EV, and then you do what we talked about before. You bridge that EV to equity value, and then you divide by what's the fully diluted number of shares. As I said before, you may not have any business with fully diluted. Just divide by number of shares that the company has and get to target share price. Generally, that's your relative valuation. It's very quick. Now, remember I started this session by saying, well, is this really valuation? The prime principle in valuation as a research analyst with an objective mind, your job is to value a company, not to price a company. To price a company means you're using a reference to what's in the market. Your job is to say whether or not the market is right or wrong about this company. Now, if you quote unquote value this company using the price in the market, you're effectively pricing that company, not valuing the company. Price is different from value. Price is what you're willing to pay for it or what the market is paying for it. Value is intrinsic. Value is what do the cash flows give me? And that's why for many young technology companies, what we do more often than not, if they have negative cash flows, blah, 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 is pricing. That's why we use price to earnings multiples, EBIT to EBITDA multiples. All that relative valuation methodology you use, they are all pricing rather than valuation. So you need to be careful. Now, why am I talking about pricing versus valuation when I'm at relative valuation? When in fact, I was talking about DCF and terminal value. One thing you should avoid doing as a research analyst, except push comes to shove, is using an exit multiple in something you call a fundamental DCF valuation. Why? You've projected cash flows for 5 or 10 years. You're doing your terminal value. You say, terminal value is too blah, blah, blah. My Gordon's growth, I need to make an estimate for growth. I'm not sure what the growth is, too many assumptions. Or your job is to make the assumptions. And you say, I don't want to use perpetuated growth method. It has too many assumptions. I want to instead use an exit multiple. You've done two things. You started with a DCF and you've ended with a relative valuation. I don't know what your valuation is anymore, whether it's a DCF, whether it's a relative valuation and intrinsic valuation. That's not to say you cannot hybridize both. You can, but just make sure that you call it what it is. So when you stand there on January, whatever that date is, or February or March, whatever that date is, make sure you state when you start. Right? You've not done a fully DCF valuation. You've done a hybrid of DCF valuation and relative valuation and your terminal value. Because implicitly, that's not DCF anymore. That's not intrinsic anymore. That's a mix of intrinsic and relative valuation. And why? Because how do you choose your exit multiple? The exit multiple would usually be based on what? The assumption of an exit multiple is you get to a point where you sell the company for a particular price, right? And to sell the company for a particular price, you need to determine what that company can be sold for. What references do you have? 2 references, 1 transaction. How have similar companies been sold in the past? They were sold for 5 times. Then you pick 5 times. 5 times EV to EBITDA, or 5 times price to earnings. You multiply by the earnings of the company and you get your price. Or you say, well, what are companies trading at currently? Those are relative valuations. They're pricing. They are valuing, in quotes, a company by reference to what is in the market. But remember, you started your this year by saying, the market could be wrong about this company. If the market is wrong about the price of this company, what makes you think the market cannot be wrong about the price of other companies? So again, your job as a research analyst is to do a DCF. That's your primary job, except push comes to shove. Cash flows are negative, blah, blah, blah. Okay, yeah. We can allow you then to use pricing. Okay. Now, I'm aware that we have just 2 hours, and I've said maybe quite a lot in a very short time. So in the very few minutes we have left, again, I know I probably went through some things really fast. The cash flows bit is very important that you get that right. The discount rate bit, very important you get that right. Terminal value, very important you get that right. It's very rare for you to go very wrong on your relative valuation. It's very easy. It's just putting multiples together and multiplying. The most important thing is that you get your peers correctly and you make sure there are no extreme values. So if you're using price to earnings, remember, if I am looking at your research report and I see there are 5 peers, 2 of your peers have debt to total capital of 60%, but CAP has 10% or no leverage at all. Your research report ended exactly where it started. It has not done anything. All right? Very wrong references. There are times when it may be right to do that, but it is rarely the situation. Okay? So look, that's everything I had in mind. I guess maybe one thing I should add from either a banking perspective or a research analyst perspective is what I've seen most times is a lot of people do Monte Carlo simulation. It's good. I'm very happy for you. It's very fancy. It looks very nice when you put it on a page. I find that it tells me very little though. It just says you've put a bunch of multiples together and your target price is still something, and this is something that's been inherited over time. If you can, there are 2 ways to approach, sensitivities in valuation. One is do a sensitivity table, sensitize your key variables. Let's know, well, that PGR you talked about, that's growth rate of 4%. What if we change it to 2%? What does your value become? That's what I'm more interested in. Those, call them very sensitive values of sensitive assumptions. I want to change them and see where it gets me. What if I change my WACC? What if I change inflation rates? All right, what value do I get? Monte Carlo will not tell you that. It only tells you, a range. It doesn't prescribe anything at the end of the day. It doesn't tell you how your value changes if you change one variable, for example. That's what sensitivity tables tell you. So data tables, for those of you who know what I'm talking about. Maybe one thing I haven't seen a lot in the last research report, and I may be wrong because I haven't seen the more recent ones, is scenario analysis. It's very common for you to, have analysts who just tell you, oh, my target price is based on this. And I have an upside of 21%. Well, that's your base case. Did you consider a potential downside case? And how do you do a downside case? Use a scenario analysis, right? Scenario management. That's more financial modeling again than valuation. But what do I want to see from a very good research report? After your valuation is all said and done, I want to see sensitivity tables. What if I change this? What percentage of my terminal value, or what percentage of my enterprise value is my terminal value? Are you doing a valuation for a mature company, a company that has lived through most of its years, and your terminal value to total enterprise value is 90%? So you're telling me that in the first 5 years to 10 years, the company is only going to realize 10% of its value. But this company is already mature. What growth are you projecting that is making your terminal value? That's a blind spot. Sometime in the future, the company still realizes 90% of the value. But this company has been around since 1957, right? So more often than not, cash flows in the near term, just because discounting, that's how discounting works, that's how mathematics works. Except if it's a very young company, then maybe 80% is reasonable. Maybe 90% sometimes is reasonable. But you're doing for a mature company that's been around for a while, not a lot of growth, and you're telling me your terminal value to EV is 85%. You may be right, but I will have a very good reason to question that. That's why I start digging into your assumptions and asking, what PGR did you use? What's your assumption for return on capital, right? And then scenario analysis, as I said. What's my base case? What I want to hear from a research analyst is, well, I also consider the potential downside case, where my revenue growth is 5% instead of 6%, where my inflation is this instead of that, where my WACC is higher than this, where my this is higher than that. So that's scenario analysis. In some contexts, you see people call it base case analysis, and then you have something called a gray sky analysis, gray as in GREY, and a blue sky, which is the optimistic view. So blue sky, optimistic. Gray sky, maybe pessimistic. All right. That gives comfort to whoever it is you're recommending that stuff. So generally, I think that's everything I had in mind. Look, unfortunately, I couldn't project a lot of the things that I wanted to. But yeah, if you guys have any questions, I am still happy to take it in case there is time for that and you guys don't have to run somewhere. Francis?
All right, thank you very much for the session, Femi. So I have 2 questions. You talk about the leverage cash flows and the unlevered free cash flows. So I wanted to ask, like, what are the situations that we have to consider using between the leverage and the unlevered free cash flows here? Then my second question is around the Gordon growth rate. You mentioned that it could be calculated using the Gordon formula, which is the retention rate multiplied by the return on capital. So I just want to clarify the type of return on capital. Is it return on equity or any form of return calculation? So thank you.
Okay. Look, on the first one, it's more about ease. So how easy it is. So when I say how easy it is, what I mean is free cash flows to firm, free cash flows to equity. Free cash flows to firm is very easy to calculate. With your free cash flows to equity, you need to get into a little bit more detail. How do I project my borrowings? How do I know what this company will borrow in future? How do I know what interest is going to be in future? So if you want to take a step to calculate your free cash flow to equity, you need to have a view on what borrowing requirements will be in future. Is it impossible? No. How can I tell? Well, I look at borrowings in the past. For example, what does the company needed in the past for every sales or for every capex? Does the company have a borrowing program, right? Is there a steady kind of borrowing repayment profile that they have? If they do, then I can project my borrowings. It's because for the operational items, you can reasonably project them without necessarily speaking to the company sometimes. But I know you guys have had a management presentation. So to keep it very simple, free cash flow to firm, that's how you start. If you think you do not have a view on what borrowings will be, or you can't reasonably project it, stop there. If you think you can, then go to free cash flow to equity. There is no, I have to do this or I have to do that. So there is no, there isn't. It just depends on whatever is easy for you, whatever information is available for you. Okay. And on your second question is on reinvestment rates and return on capital. How do you choose, or what kind of return on capital? The return on capital I meant is return on invested capital, which is usually your NOPAT divided by your invested capital employed. And how you calculate your invested capital, it could be your non-current liabilities plus, or you can very simply do total assets minus current liabilities. Or what you can do is just pick the equity of the company and add the borrowings as well, because that's the capital that's been invested by investors. So equity investors invest equity. You pick the equity from the balance sheet. And debt investors will give you borrowing. So current borrowings and long-term borrowings, you add both together. That's your invested capital. And then your NOPAT on top. That's your NOPAT being your net operating profit after tax. That's how you calculate your ROIC. That's return on invested capital. Okay? Mubarak.
Okay, thank you. So you said while undertaking the relative valuation, we are to consider the forward multiples, specifically, let's say for the EV to EBITDA, for instance. Yeah. But my question is, let's say, for instance, we're actually taking up our DCF valuation and we have to calculate our terminal value using the exit multiple. Are we also going to be making use of the forward multiples, or we will be calculating that based on the historical multiple?
Now, that's a good question. I am inclined to say if your exit multiple is based on a trading multiple, it has to be a forward multiple or some standard multiple used in the industry. For example, in retail, well, in the UK at least, or in Europe, we use 6 times, and it's 6 times, it's always 6 times, but for a reason, because most transactions and most trading usually revolves around that value. So if you want to use an exit multiple, it should be a forward multiple. What do I mean? Remember, every valuation exercise that you do is almost always based on a forward number. So if you remember basic DDM, it is D, that's your D0, D0. If you remember that from finance, multiplied by 1 plus G, it's almost always forward, 1 year ahead at the minimum. So to answer your question very simply, if you're using a precedent transaction multiple, maybe you can say, oh, some transaction happened in this sector. Maybe someone bought Portland. I think it was even CAP. Bought Portland for a price. And because that company is no longer traded, I can't get their multiples anymore. But when the company was still being traded, when they were still releasing results, what was the last 12 months numbers? Or was the 2020, whatever number? What was the last reported number? Oh, it was this. Okay, can I use that multiple? Yes, you can. But just remember, if you do that, let's say transaction price is 1,000 and the latest revenue, the latest EBITDA was 100. That gives you a 10 times multiple. That's for present transactions now. You need to multiply that by the last 12 months EBITDA of CAP as well to get the value for CAP. However, if you're basing it on a trading multiple, this is what peers are trading at in the long term, then it has to be a forward multiple. So for example, if it's price to earnings, it's like price to 2020. So if you project for 5 years, it will be price to 2027 multiple, if that's available, if you have research analysts projecting for that long. So forward multiples for trading multiples, maybe LTM multiples, that's historical multiple for precedent transactions. Okay, John.
Hi, thank you so much for taking your time to explain all this. They are really, really helpful. The other time you called me, I was trying to unmute, but I couldn't do that. So, my question would be around the GDP for the calculation of the for the growth rates talked about during the Godon calculation. And my question around this is as to the exact GDP we should account for. We have the real GDP and we have the nominal GDP. And the nominal GDP ordinarily accounts for factors such as inflation, right? And you talked about how inflation itself should not really be given much consideration. But now if we consider the context of the economy we're dealing with, for instance, in Nigeria, over the years, the inflation has actually been on an increased speed, as opposed to a developed economy where we actually have policies in place to keep them in check. So if we do not foresee policies in place in Nigeria that could keep inflation in check, should we account for it or should we just discard it all the way?
That's a good question. To keep it simple, you tend to use a nominal GDP growth rate. And I'll tell you why. So the reason I talked about inflation is, so people, it's a bit of a long story, but I'll tell you what people say when you use inflation rate as perpetual growth rates. They say, well, if this company doesn't need to spend money to grow anymore, at least its revenue will grow by inflation. And so if its revenue grows by inflation, then it doesn't need to reinvest capex, blah, 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 and all that. It's not complete logic. It's not complete logic because even if the company doesn't invest growth capex anymore, right? You say you get to a point, steady state, where your capex is equal to your depreciation. But what that does is you're assuming that new capex replaces old assets, right? That's what it means essentially for capex to be equal to depreciation. Because depreciation means your assets are declining, but to keep your business running, you need to invest. But you're only investing enough to maintain the business. That's why we call it maintenance capex. But even that maintenance capex will be growing by the same rate of inflation. So you've got your revenue increasing at inflation, but you also have capex increasing at inflation. Now remember that what we're talking about is free cash flow growth. So that if my revenue increases by inflation and my capex also increases by inflation, do I really have growth? Because steady state growth implies that you are no longer really investing a lot of capex to grow the business, but just by the virtue of the fact that a lot of money has been invested in the past, or a lot of money will be invested in future, you can achieve a growth rate that you don't need to make an explicit forecast for, a growth you don't have to explain per se. So why should you use nominal over real GDP growth rates? Now, remember that if I grow, because at the end of the day, and you made a very good point about inflation not being in check. So if nominal GDP growth rate in the next 5 years or in the next 10 years is projected to grow by, let's say nominal growth rate is supposed to grow by what, 5%, and real GDP growth rate is supposed to grow by 4%. Either way, you have a similar impact on your value. The more defining point in your question is the GDP growth rate, which is why I did not specify in the first place, whether it is real or nominal. Now, by using GDP growth rate, you are saying, well, if there is no inflation and the company were to grow with the rest of the economy, how much would it grow by? Then real GDP growth rate, so that's fine. So if you use nominal, it is not bad, even though you have a long-term inflation that is high. Why? Because that inflation by itself is It affects both the amount of money you have to reinvest and as well as your revenue. However, the real GDP growth rate in itself has no bearing with your capex, because if you say it grows in real terms or it expands naturally, it's a natural growth rate, so that even if it's just maintenance capex you have, your revenue will grow still. However, remember, by the time you add that inflation element, as your revenue grows in real terms, it also grows in nominal terms. However, your capex doesn't exactly grow because you've gotten to steady state. But the inflation element you've added to the nominal GDP growth rate means that there is an inflation element also affecting the capex. So in some way, it cancels out that inflation element. But the real element is where the actual growth is. And that's why what some people do, instead of using real GDP growth rate, for example, or nominal GDP growth rate, whatever, is they use an interest rate. So the real interest rate or risk-free rate, they just broadly use a risk-free rate to grow the economy. But that's a different argument. Yeah. But point is, what is actually growing your economy? And I'm not sure if, I don't know how much disclosure there is, especially for Nigeria, as an example. In terms of GDP growth rate, do you often get the real GDP growth rate or you get the nominal GDP growth rate? In any case, either should be fine. You just need to be sure what you're assuming. If you're assuming nominal GDP growth rate, then it means that your revenue grows by, let's say 4% in real terms. That's the quantity grows, and let's say price also increases, but not just because of inflation, not because everything in the economy is, getting just increasing in price. The concept of real GDP growth rate means the quantity. So you remember, revenue is quantity multiplied by price. The quantity will grow. Could be because you have, a larger population. You'll just have more people to sell to, right? While spending maintenance capex. The concept of nominal GDP growth rate or the inflation element there means you have more quantities, but the price has also increased. For price to increase, price will not increase in isolation. It's not just your selling price that will increase, cost price will increase as well. So your cost will increase similarly. So it nets out in a way. So if you have nominal GDP growth rate forecast, use that. If you have real GDP growth rate forecast, use that as well. But more often than not, you use nominal. Okay, Balimi.
All right. Thank you so much, Femi, for taking our time to explain all of this. It has been an insightful session so far. So my question is on the subjectivity of weights. So when calculating cost of equity, for example, looking at beta, so maybe after arriving at an adjusted beta from a regression analysis, taking one from fact sets or taking the median from comps and arriving at 3 different values. So would you advise that we just go with one, or we take all 3 and then weight them? So if
I like
it's going to be
I understand your question. Sorry to interrupt you. I like analysts who do, so that's what I do. I like analysts who say, well, I know one way to calculate it. But in case you are questioning my value or you're questioning my skill as a research analyst, there's an alternative way I've calculated this and I've used another kind of data. So don't weight it. That's something a lot of analysts do. Rather than doing scenarios and showing me this is that, they just show me this, I applied 30% to this, 40% to this, and 30% to this. How did you come about 30, 40, and 20%? Now, what a good analyst should do is, I know beta is subject to different calculations. So I've come up with, I have all you need. I did one using regression. I did one using this, and my results are similar, right? Or if my results are different, how much does it affect my target price? Which is why I was talking about scenarios, right? One analyst said my upside case assumes a regression beta of this. My cost of equity is so high because I've used regression. But when I use data from Bloomberg and I do the, unlever relever process, this is what my cost of equity is. If I apply that same cost of equity, I get a lower valuation, but I still have an upside, or I have a downside, or I have something, right? So what's scenario 1? What's scenario 2? What's scenario 3? And I've often heard in the past that that's usually what makes a difference between research reports coming from, say Nigeria versus some of these other, call them developed economies. Because, but like when I was in Nigeria, I can't remember a lot of research reports that had like a bunch of scenarios and said, look, this is scenario A, this is scenario B, this is one scenario versus another scenario. It's something you find more in places where things can, they recognize that things change a lot, or there are different approaches to calculating things. So that's probably one thing you want to consider. So don't weight it. Just do it separately and get two different values and say this is one value is in this scenario, that's another value in another scenario. It could be in your sensitivity table, it could be in your scenarios. Okay?
Yes, thank you very much.
I have run past time and I'm extremely sorry for that. So I think that's about it from me. Sorry. With this, I think there are no more questions. So thank you.
Okay, Femi, and thanks a lot for the session. I think what we'll do, and probably yes with you after the session, is to see how we can put together materials or additional content that the student could sort of leverage. We'll try to share a few information with them earlier on, but I think we can work together to just put together say documents or materials that will be useful as reference points or to the student. Should they have any question at all, maybe as you are implementing your valuation session, should you have any question at all, you can always send it over and we'll find get it to Femi, and he will be able to put together a response at his earliest convenience. Or Femi, if it works for you, we will reach out after the session and see how we can put together for lack of a better word, body of knowledge for the student to sort of leverage on as they continue their preparation and as they continue to put together their report, if that works for you.
That should be fine. It's just most of the materials I have are proprietary. I'm putting slides together. It just takes time. And it takes time because you would want to do it well in situations like this. So like the ones I shared the other time on screen, they are not like my materials. They're materials that I just thought were relevant to show you guys.
Okay. I mean, nevertheless, I'm sure we'll find a way around this, and as much as possible, we would work to get in some material to use. I think that is about it from this end. I don't think there's any other question. The second session for today we hold later this evening by 4 p.m. I think that's financial analysis, the concluded section of financial analysis. Once again, Femi, thank you. And I can see that Abraham is in the room. Just checking, Abraham, if you have any parting comment.
None. I just want to thank Femi for the session. Thank you so much.
Yes, boss.
All right, then.
All right. Thank you very much, guys. Thank you.
Have a good day. Thanks.
Bye.